Hello, I'm going to show you my live trading results from the last 2 years. I'm externally recording this monitor to prove that this is not photoshopped because I know many gurus play games and tricks when it comes to screen recordings. I'm going to show the percentage of my returns. I'm going to cover the dollar amount just for privacy reasons, but you guys can do the math. So for the past 2 years, 539 days, I made 14,000% returns. On a monthly, 31%, and of course, a real account at a strike rate of 67.8%. The money makers for me been gold and Nas100. But let me show you guys how I did it. So let's get into my Nas100 strategy, pre-market liquidation. Before that, we need to understand what pre-market data is. Pre-market data is the price movement prior to the New York Stock Exchange open, which is 9:30. This period allows both retail and institutional traders to participate in those sessions. The range is from 4 a.m. to 9:30 Eastern. So here, this would be our pre-market data from 4 a.m. to 9:30 Eastern. So to understand this, there is huge business getting done in this area. Institutions inject a lot of liquidity, aka money, in this area. Why? Because think of it like this. When 9:30 comes in, the New York Stock Exchange opens. You always see Nas100, US 30, or SPX 500 just rallying at 9:30. That just shows there's a lot of money that got put in at that moment. But do you think all that business was done at 9:30? No, that business was done in the pre-market. So you would always see odd price movement, which would be considered as thin liquidity for, let's say, this is 9:30. This is the 9:30 mark. Price comes up to the 9:30 mark and boom, explode. This movement is not inserted at 9:30. It's really inserted in the pre-market. After understanding what pre-market data is, what we need to do next is grab the high and the low of the pre-market to identify it as our range. Again, we need to grab the high and the low of the session to identify it as our range. Then we apply our 0, 25, 50, 75, and 100 ratios on it via Fibonacci tool. So this would be our Fibonacci tool. This would be our 0, 25, 50, 75, 100. This is our Fibonacci tool. And where did we apply it? On the pre-market data's high and the pre-market data's low. Let's go to an in-chart example to take a deeper look. So here we have our range, our pre-market data. So this was our low and this was our high. So in this strategy, what we look for is a pre-market data liquidation. So a fake out. So let's say 9:30 comes in. Price is right here. We need price to take out the range and come back into the range. A fake out, building liquidity over here, to later on come back to the 50% and react from the 50% to liquidate the previous market liquidation. Again, we need price to do what? Come back outside of the range, to come back in, to use the 50% mark. What is the 50% mark? The fair value. Price always wants to rebalance itself, to go back to the middle, to go back to where price was fair. Now, ideally, price should come up to our premium levels. And like we said earlier in our previous videos, it's best to sell off at premium. But what I realized after backtesting and trading for so long, specifically this strategy when it comes to NASDAQ, price rarely reaches for premium levels. It will usually reach for the fair pricing, rebalance itself, and sell off after here. So what we're going to look for is a breakout and a retracement to the 50%. And as you guys see, this is what happened. Price came outside of the range, came back to the 50%, stayed in the range a little bit, revisited the 50% one more time to sell off. So in this strategy, the name of the game is high percentage plus your risk to reward. So your risk to reward can be not all the way. So It might be a little bit confusing, but stay with me. So this is your premium level. Price does have the potential to reach the premium level, right? So we would half of the premium level. This is where our stop loss would be. Why? Because if price blows through this level, it's more than likely to switch direction and go the opposite way. So what you would do is you place your stop loss here. Now, if you take a loss, what I usually do, I always hedge. I make my loss a little bit smaller. So let's say I lost $300 in this trade. I would try and recoup at least. Half of that via going on along in the opposite direction, because I know the fact that price did not reverse at fair price or my premium pricing, it's more than likely to switch direction where I can catch a quick buy right here and at least make half of the money that I lost when I was selling. So price reaches here, you get in a sell, and your target should be last day's low, which you could target. This would be last day's low. Or if price fakes you out and you take a loss right here, you can always hedge and make half of your percentage back. And that's how I've been trading to make these enormous results consistently too. So this strategy works consistently, but the main things going along with the strategy is having the right bias too. So you always need to be in line with your bias. That's one of the most important things. ADR goes out the window when it comes to NASDAQ. So you guys know I love teaching about ADR, the average daily range. But when it comes to NASDAQ, it usually goes out the window because every day is almost like a new day when it comes to NASDAQ 100. It's different volume. That's why we focus on our pre-market data. So again, guys, hopefully I helped. And make sure you check our website for more information and like, comment, and subscribe. Thank you.